Hello, welcome to the SB2 monthly webinar. It's Greg Taylor here. We will be starting the webinar in about 1 minute time. We'll just let a couple of people join the forum and then we'll make a start. So thank you for your patience. Okay, I think we'll make a start, and as is always the case, a recording will be made available following. So for anyone who was a little bit late to the party, they can catch up via the recorded version that will be posted again. So hello and welcome to the Salter Brothers Emerging Companies Limited monthly webinar. It's relating to obviously ASX code SB2. My name is Greg Taylor, portfolio manager of SB2, and the purpose of today is to give a bit of an overview and update of what's happening in the markets, what's been happening with the portfolio, dive into a couple of the key stock holdings in the portfolio where we have a couple of the analysts presenting the investment thesis, and also just give you a little bit of an update on a few other matters, both with the unlisted portfolio and also just with a couple of sort of administrative and capital management matters for the fund. So just recapping, it's the Emerging Companies Limited, Salter Brothers Emerging Companies Limited Fund. It's a listed investment company on the ASX under the code of SB2, and remember our mandate is dedicated to investing in small cap Australian companies with a market capitalisation of under $500 million. The fund does have north of a 4-year track record now, and a consistent record of outperforming the market. And most recently, today we'll be talking with the lens of the September quarter, the 3 months to September 2025, and during that period the fund returned a positive 8.8% to unit holders. Another dynamic of the fund, which we've spoken about consistently, is that the share price of SB2 continues to trade at a discount to the underlying post-tax net tangible asset value of the fund, and as at the end of September that was at 33%. I'll give a little bit of an update on a number of the initiatives around continuing the endeavour to close that discount, though I do note there has been a little bit of share price strength so far this month, which is well received. Before I jump into the broader overview, there's just a couple of matters to sort of update investors on. Firstly, today we announced the extension of the share buyback. That was done via an ASX announcement. So that's an extension for another 12 months to continue the share buyback as one of those endeavours to close the discount. And what we've been active with that buyback more recently, and that will continue going forward. Also, just obviously we announced the dividend with the full year result, which was announced in August, and that's been paid in the next week as well. So shareholders should receive their dividend payment also within the next week. So that's that's been well received by many. So I'll talk about a few of the other initiatives and outcomes in the portfolio as I jump into the future slides. But before I go into specifics, if I just jump over the slide, I thought it'd be useful context just to talk about market performance over the last 3 months and what's been driving market performance, because there has been quite significant divergence across the various subsectors within the market. And so quite a busy chart here, but there's a table underneath as well which basically just summarises the performance of the various sectors, whether it be by size, small versus large cap, and then also by sector, splitting out the industrials versus the resource stocks and market, and also some reference to the technology index. Pretty unique times. It's not very often that you get any index moving north of 20% in a 3-month period, but that's what we've witnessed over the September quarter with the small resource sector, predominantly driven by gold and silver stocks, and the gold price and the silver price have had significant upward trajectory for the big part of this calendar year, and that's accelerated over the last 3 to 6 months. Notably, that's sort of started to reverse a little in the month of October, and more particularly this week. But what it has resulted in is, especially the small ASX-listed small gold companies have had some pretty phenomenal returns, and the broader index is up again 23% over that period over the last 3 months. And if you contrast that to the small cap industrials, it's been about half of that performance, about 10%. So, and then if you just look at the larger cap end of the market, similar dynamic where you've had resources outperforming industrials, but the large cap industrials had a lot, they had a negative month in September, and a modest sort of 1.8% positive performance for the September quarter. So real disparity of returns, and it's difficult for us. We don't manage the portfolio to a benchmark, but it is worth noting that we do not invest in resources, and definitely not in gold and silver companies. So it's we didn't participate in that short-term upside, but equally we've been protected over the last couple of weeks, where last week in particular, there's been a pretty significant sell-off in those stocks from their highs. So yeah, interesting time. We often point to the ASX Emerging Companies Index, XEC, as a benchmark, but increasingly that's getting dominated by these small gold companies and resource companies, so it's becoming less instructive. So just gives you a feel for, but again, we spoke about during the what's the asset class. We're definitely small cap, and we're definitely probably more closer to micro cap than small cap, and we very much focus on industrials and technology companies. So a blend of the small industrials and the ASX Tech Index is probably the best barometer for our portfolio, and it largely correlates to the portfolio return of positive 8.8% over that period. Looking forward, we still continue to believe there's significant upside for small industrials relative to larger cap industrials, and with the recent movement in the resource sector, it feels like they are at the higher end of the valuation spectrum, and we're probably pretty confident about small cap industrials being still the best sector to be exposed to over the next sort of 12 to 24 months. So if we jump over to the page, similar with recent presentations, we're going to have each of the analysts within the team present an overview of a key stock or company holding in the portfolio, and we'll start with Dane Grant speaking to our recent investment in Murray Cod Australia. Over to you, Dane.
Thanks, Greg. So Murray Cod Australia is an inland aquaculture company that operates a vertically integrated model, breeding, growing and selling their uniquely optimised premium Akuna Murray Cod. MCA listed on the ASX back in 2017, and by 2020 had established a strong operation before experiencing distributional challenges during COVID, which halted their international exports, prompting a strategic decision to slow down operations. From 2022, MCA has since expanded their grow-out facilities from 33 ponds to 128 today, with near-term development plans to reach 176. And have spent over the last few years a significant level of cash investing to restock and grow their fish to a saleable size. This was pretty prevalent in FY25 as they grew 3 million fish while selling just circa 250,000. And doing so, this allowed a large increase in biomass on hand, which increased from 945 tonne at June 2024 to 2,500 tonne at June 2025. And alongside this, MCA has also been expanding their facilities with capacity today to spawn 6 million fingerling or baby fish per annum, as well as an extensive processing facility and material water rights. The opportunity we see in Murray Cod is for them to begin realising the value of their biological assets, with current intentions to sell over 1,000 tonne in first half 26, enabling them to sustainably continue expanding their farms and increasing the reliability or sustainability of their supply. Further, we expect significant value to be realised if they can continue shifting a greater proportion of fish to be sold over 2.8 kilograms, as the market is willing to pay circa $27 per kilogram for larger fish versus 24 for fish under 1.2 kilograms. And then again, further upside should a greater proportion of fish be sold in international markets where they can achieve a further 20% price premium. In addition to this, MCA also continues refining their operational processes, and particularly their bloodline of Akuna Murray Cod, specifically breeding the best tasting, most disease resistant and fastest growing fish, with Akuna Cod today tasting on par with premium white flesh fish that have market prices between $45 and $60. And they've also seen a strong increase of the annual growth per fish, pushing up from 800 grams per fish closer to 1 kilogram per annum this year. With these continued business improvements led by the highly experienced and aligned management team, we expect over the near to medium term there should be substantial returns to shareholders.
Thank you, Dane. Yeah, I think that's a classic example of what we look for in the portfolio. One is, really different exposure, provides some diversification, and the performance of this company is going to be largely uncorrelated with many other sectors in which we already invest, which is of appeal. And we also look for sort of not undiscovered, but opportunities where the future value may be masked by some near-term events, and those near-term events they're building up this great inventory, and once they start to sell that inventory and that converts into cash earnings, we really think there's a mispricing in the market for Murray Cod at the moment, and that provides a near-term catalyst and significant upside to the share price over the next couple of years. So excited to, again, we added to this position via a placement, while the company raised some money to fund its future growth initiatives as well. So believe it's well funded with some good catalysts and upside to the current valuation. So thanks again, Dane. So we're going to jump over to Frankie, who is a senior analyst in the team, and we've been covering AI media for a while now. It's been a key portfolio holding, and Frankie's done a lot of work on this over the last couple of years, and so I'll let him take us through the latest iteration of the investment case.
Thanks, Greg. Yeah, so just run through the investment case for AI Media. AI Media is a global leader in AI-powered captioning, transcription, and translation, delivering its solutions through its Lexi platform, enabling real-time media accessibility across broadcast, government, and enterprise markets. Toll Brothers have been a long-term holder, first becoming substantial in July of 2022, and remain supportive of the company's transformation to a higher margin, technology-led, and it continues to be a top 5 portfolio holding. Over September, AI Media was the top portfolio contributor following a constructive FY25 trading update at the end of August, highlighting 19% growth in technology revenue and reaffirmed the path to sunset lower margin legacy offerings by 31 December 2025, supporting the shift towards higher quality recurring revenue streams and driving structural margin expansion. As legacy services are phased out, AI Media's transition continues to reveal strong technology momentum and improving profitability, with tech revenue growing at over 30% CAGR over the past 3 years, and the company progressing towards Rule of 40 metrics. At the September AGM, management showcased Lexi Voice, the next generation AI product, alongside customer case studies demonstrating operational efficiency and adoption across enterprise and media workflows. The early customer wins and positive feedback provide encouraging validation of the product scalability and market fit. AI Media's ongoing strategy centres around its 9 squares of expansion, targeting broadcast, government, and enterprise growth across the Americas, APAC, and EMEA, providing a clear bridge to its FY29 aspirations of 150 mil revenue and 60 mil of EBITDA. While the business remains predominantly driven by broadcast customers in the Americas, recent momentum in Europe has been productive, supported by the introduction of the European Accessibility Act, which came into effect in June of this year. The position was modestly adjusted as part of active portfolio management, but it remains a core conviction holding, supported by its technology transition and innovation momentum as key drivers of long-term value creation. Yeah, that covers the investment case. So hand it back to Greg.
Thank you, Frankie. And yeah, as was touched on, it's been a long-term holding. I think we built a position initially under 30-cent share price in this name, and it's now trading at about 90 cents, I think, as of today. And so it's been a great performer for the fund. But I think I've spoken in a number of forums over the last couple of years that I genuinely believe that this company has the opportunity to be what we all refer to as a 10-bagger or a 10x return over a 5-year period, and we've seen a 3x return and managed the position size throughout that, but still really confident about further valuation upside for AI Media, and really believe calendar year 2026 is going to be when it really starts to attract attention from the broader market. So exciting times ahead, and good news story for investors. Thanks again, Frankie and Dane, for that update. Jumping over to the portfolio positioning size, and before I talk too much about what's on the slide, I actually also presented at a small cap online conference last week, which was run by Ausbiz, that sort of finance media platform, and I spoke to 2 key holdings in the portfolio at length in this forum, and we've made the video recordings of that interview and presentation where I actually sat with management and spoke to the investment thesis and the key drivers for those respective businesses. So the 2 businesses I spoke to one was Better, BBT is the code, which, as you can see here, is one of the top 5 holdings. So I spoke at length about that. And then secondly, the other company was Simmel, which I think you'll see there's also a top 5 holding in the portfolio. And yeah, so for further information there, the interviews were released on our LinkedIn page, but also will be made available on the Solder Brothers Emerging Companies Limited website. So yeah, for further colour on those, we've spoken about AI media, and only recently spoken about our Fabs and Worker in this exact forum. So hopefully starting to give our investors a feel for what's in the portfolio and why we've taken those positions. This slide, again, just really just highlights why we're so optimistic about the outlook for the portfolio and the sector as a whole. But I've spoken about many times the ability to assemble a portfolio of sort of 25 holdings that have an average revenue growth rate north of 20%. They're profitable and are trading on very attractive valuation multiples. Like if you look at the PE multiple, we're circa 10 times for the fund, and the market's sort of north of 15 times PE. So you've got based on our forecasts and our positioning, a portfolio that's growing faster than the market, is profitable, and is valued significantly cheaper than that of the market. So we think we're in a good spot. One thing I'll just speak to, which isn't here, it's this dynamic about the fund does have about a 15% exposure to unlisted investments. And I've spoken again at length over recent forums that there was the likelihood that there may be some exits or liquidity events in those unlisted holdings, and so that continues. And I've spoken in more detail about two of the larger unlisted holdings, which are a business called Ipsy, which is a fintech business, and another business called Pelican, which is a sort of global software business in the asset protection space. Both of those key holdings continue to go into a formal sale process, and there's advisors appointed and quite engaged buyers on the other side. So there's no certainties in life, but they continue to progress positively, and again expect to have some updates for investors in the coming months. And in the event there is an outcome there, it's very much likely to be a positive valuation impact to the fund, and creates some additional liquidity in the fund as well. But what has occurred in the last month, and it was actually announced only earlier this week, was one of our smaller unlisted holdings was a company called Sphere for Good. It was a fintech business, and it has been announced that it's agreed terms to be acquired by an ASX listed company, Findi, FND is the code. That's scheduled to complete in November, what that will see is that that unlisted holding will become a listed holding, i.e. we will now hold shares in the parent company that acquired that company, which is Findi. We might talk to that company in the coming months once that's all completed, but it's the first of potential multiple realisations of the unlisted portfolio into listed and or cash, which I think will be very beneficial for the underlying unit holders. If I jump over the slide, the initiatives around closing the discount. Again, I touched on these at the opening, but again, you've seen we've been active in the buyback, and today announced a 12-month extension to the buyback to buy up to 10% of the company back at the current discounted levels. And I also spoke to that the annual dividend is due for payment this week for eligible shareholders who were holding at the record period. So we're continuing the marketing initiatives. I noted the small cap conference that I presented at last week as just one example, and continuing to meet with investors around the country in face-to-face forums. And we touched on that the fund has been rated. So we had an independent rating of the fund, which again came out very favourably, and a copy of that report is also available for investors upon request and via our website. So, again, continuing to work hard on closing the discount, and my mind, potentially a couple of these, the ongoing marketing initiatives combined with ongoing positive performance, continuing the dividend and the buyback, and potentially a real catalyst could be some transactions in the unlisted investments, unlocking not only liquidity but liquidity at a reasonable premium from their current holding value. So that was all I planned on covering today. As always, a copy of this presentation is available on the ASX. A recording will be made available. Our contact details are here in the deck, where if you have any ongoing questions, please feel free to reach out. But what I'll do now is just pause and check in if any questions have been tabled in the Q&A chat function. Megan, is there anything there
No, nothing, Greg.
No, okay. All right, well, thank you all again for taking the time to listen. Again, thank you to Frankie and Dane for their insights, and look forward to providing a further update next month. Goodbye.